Futures contract. A futures contract is a standardized legal agreement traded on regulated exchanges, where one party agrees to buy and the other to sell a specific asset at a fixed price on a future date. In these contracts, the buyer holds a long position with an obligation to purchase, while the seller takes a short position with an obligation to deliver the asset. Most traders close out their positions before expiration to avoid taking physical delivery. Futures contracts serve two key purposes: hedging and speculating. Hedgers, like airlines locking in fuel prices, use futures to manage risk by securing prices ahead of time, while speculators aim to profit from price changes. Because futures use margin deposits of 5 to 15%, leverage can magnify both gains and losses, and prices in these markets often act as leading indicators for inflation and broader economic activity. A trader buys one June crude oil futures contract at $75 per barrel. Since each contract covers 1,000 barrels, the total value is $75,000, but the trader only needs to put up about $6,000 in margin. If oil rises to $80 by May, selling the contract earns a $5,000 profit, which is an 83% return on that margin. Remember, leverage works both ways, so a $5 drop would have caused an equally large loss. Futures contracts serve three main purposes. An airline might hedge against rising fuel costs by buying jet fuel futures now. A trader might speculate on a wheat shortage, hoping prices climb. And spread trading lets you buy one delivery month while selling another to profit from price differences. Either way, your profit or loss comes from the difference between entry and exit prices multiplied by the contract size and number of contracts. Futures trading has common pitfalls that new traders should watch for. A margin call can happen if losses reduce your account balance, forcing you to add funds or have your positions sold. Also, holding a futures contract until expiration may require you to take physical delivery of the commodity, and rolling over to the next month comes with costs and price differences. Finally, remember that futures prices can diverge from spot prices due to carrying costs and market sentiment.